Hi, good morning everyone. Today we're going to discuss the topic IFRS 9 financial instruments. Now, this is one of the most relevant topics considering the impact of IFRS, especially on the banking companies or the financial institutions. But then, well before we get into the complexities of the financial instruments, let's try to understand that does any company's business get impacted by this particular accounting standard or not? What we're going to do is today, we're going to look at some basic attributes of financial instruments, looking at something like a meaning of financial asset, something like a financial liability and things like that. And we'll use some basic examples to understand in terms of what is basically a financial instrument all about. Do we ever or have we ever dealt with a financial instrument in our real life or not? And then gradually we're going to talk about something with the accounting part of it in terms of how do we account for a financial instrument and whether we go for something called as it's an early part of the discussion we're looking at it, something like a cost method or a fair value method. We're going to talk about that out all today, right? So when you look at a financial instrument, I define it as a contract. So what we're saying is there are two parties which enter into a contract wherein one party, one entity has a financial asset in its books. We're going to discuss the meaning of financial assets in a minute. And the other entity has a financial liability or equity in its books. Now, this is a bit more technical definition that we're looking at as of now. But then if I say I'm talking about a financial asset, I mean to put it like this: a right to receive money. In a layman's term, we are looking at it, a right to receive money, right? And if I look at a financial liability, we are just stating it as an obligation to pay money. So what we're saying is, there is a contract between two parties wherein one party is entitled to receive money or something equivalent to money, and the other party is obliged to pay something or something equivalent to money. For example, if I say that company X sells goods to company Y on credit. Now, I would say there is a receivable in the books of company X and a payable in the books of company Y. But then company X has a right to receive money. So a receivable becomes a financial asset. Or in a way we can say a receivable is as good as a financial asset or is an example of a financial asset. Right? Vis-a-vis, company Y has an obligation to pay money because there's a contract that the goods have been sold off, and company Y is required to pay money for those goods, and thereby it becomes a financial liability as far as company Y is concerned. So we are saying that a payable is an example of a financial liability. So that is one of the easiest examples to talk about. Think about it like this. Let's say I deposit money in my bank. A company has cash at bank, a bank balance. What does it mean? What does it imply? It implies that the company has, or I have, a right to receive money, and the bank has an obligation to pay money. So even that is an example of a financial instrument. Are you okay with that? So you can think about a lot of examples around your life where you would say that, well, I didn't know that it was a financial instrument, but in reality it is. Right? Take another example for it. Let us say that company Y issues bonds. So there are a lot of people who buy the bonds in company Y. So for those people, it's a right to receive money, financial asset. Upon maturity, they can claim the money from the company. For company Y, on the other hand, it's an obligation to pay money at the time of maturity. Right? And that is where it becomes a financial liability. Are you fine with that? So you would come across a lot of situations, a lot of scenarios where you would see that it's a financial instrument even though you did not know it. Are you okay with that? Let's take one more example around this. Say that company X issues shares to company Y, right? Now, I'm not saying that they are issuing shares with respect to, let's say, any, assets being acquired, things like that. All that's still a part of this particular discussion. But let's say company X issues shares to general public through an IPO or something like that, right? Now, here we are saying company X is having an equity in the books. There's no financial liability or an obligation to pay money. But then there is an equity in the books of company X vis-a-vis for the investors. There is still a financial asset. There is a right to receive. Although under the going concern assumption, we can still say that company Y cannot claim the money until the company is dissolved, until the company has gone into liquidation, which we don't assume while preparing the financial statements. But then the definition of financial instruments does consider that one entity is having a financial asset, which is company Y. They have invested in the shares in company X, sorry. And for the other entity, that is company X, there is an equity in origin. So even this is going to be covered as a part of the definition of financial instruments. Are you okay with that? So the key is that if we understand fairly well what is a financial asset and what is a financial liability, then we are able to account for this entire accounting standard. It appears a bit simpler, but then there are of course challenges associated with that. We'll talk about that in a while. But then, just to summarize what we have done so far is, we are saying that where one entity has a financial asset and other entity has a financial liability or equity, that contract would be called as a financial instrument under the purview of IFRS 9. Are you fine with that? Yeah. So let's try to spend some time to know what is a financial asset. What defines a financial asset? That is something we want to talk about. Precisely, we are saying that if I have so they haven't really, defined it in an easier manner. They have given quite an exhaustive definition. Quite an exhaustive definition of what is a financial asset. Likewise, they have also tried to define financial liability. But then, briefly, if you look at it, I'm not going to discuss the entire definition of financial asset today. But I'm looking at if, let's say, there is cash, that is an example or that is coming within definition of financial assets. A right to receive a financial asset from other entity. I can, in a simplistic manner, say I have a right to receive money from somebody else. We talked about receivables. It's a financial asset, right? We talked about investment in debt of another company. That's a financial asset, right? We have a right to receive money, right? But then it also talks about right to exchange financial asset with other entity under favorable conditions. Now, this is not exactly the technical definition, But it does talk about that if the conditions are favorable and I might even want to add the word liability here, right to exchange financial assets or liabilities under conditions which are potentially favorable to the entity. So that is something which is the precise definition of this particular part of the definition of financial assets. I'm going to use some example to measure, or let's say discuss in terms of what is the implication of this definition. What does it mean actually? So I might want to kind of take some space here to discuss this particular point. What could be a favorable condition? What could be the right to exchange under such kind of potentially favorable conditions? Let us say that there is a company X that enters into a contract to sell, let's say, $100,000 at the rate of rupees 60 after 3 months. Now, why would it enter, or what could be a circumstance in which company X might be able to enter into such contracts? Let us say that company X is exporting goods, exporter from India, selling goods to a US based customer. So what we're looking at is after 3 months, this much money will be received by the exporter. This much money will be received by company X. But then company X is an Indian company, which means that they need to convert these dollars into rupees equivalent. So now the company is a little concerned that if the USD rate declines, right? If the USD rate declines, they would land up into a loss. And just to protect or hedge itself from that risk, the currency risk here, the exchange rate risk here, the company enters into a contract with a bank wherein it will sell these many dollars at rupees 60. When? After 3 months. So there is a maturity time. But today, the company has entered into this particular contract with the bank. Let us say, after 3 months, $1 is equal to rupees 50. I'm just putting in a very extreme rate here, 50 rupees, right? Now, the key is that this is the spot rate. The spot rate is rupees 50 per dollar. But then, the contract allows company X to be able to sell every such dollar at rupees 60. And that is where we say there is a contract which allows the entity to exchange the financial asset. What the financial asset is? The dollars. They are exchanging financial assets from the bank or with the bank under potentially favorable conditions. The conditions are favorable. Dollar has gone down, but the contract allows you to sell it at a favorable rate or at a better rate for you. And that is where this contract is also becoming an example of a financial asset. Are you okay with that? At the same time, we can also say, had this rate gone to rupees 65 per dollar after 3 months, then the same contract would have become a financial liability. So somebody needs to be careful about it, that under financial instruments, there can be one contract which could be a financial asset at one time, or it could also be a financial liability at some other point in time. Are you okay with that? So that is something which needs to be understood well. That's something that to be taken care right away. So it means that my accounting under financial instruments can vary, can change from time to time. And that is where I need to be careful about how should I look at the right accounting perspective. Are you okay with that? Yeah. Great. Now there are still more parts of this particular definition. As of now, we do not want to get into that. But we would want to spend some time understanding how to do the accounting. So let's put that point here. How to do the accounting for financial assets, right? Now, when I say I'm looking at a financial asset, we, in a layman's term, we said that it is a right to receive money, right? A right to receive money under some potentially favorable conditions. That is something which is an extension of this definition. The key is that if I have, let us say, a financial asset in my books, right? Let us say that I invested, let's say, in 100 shares of company X at the rate of dollar, let's say 10 each. Now this means that my total financial asset are 100 into 10, which is $1,000. The question arises, how do I account for it? As in, what should be my first entry and what should be my entry on the balance sheet date, on the reporting date? How should I account for it? That is something we will talk about. Yeah. So if I say that I have a financial asset worth $1,000, I can simply say debit financial asset $1,000, credit bank $1,000, right? But then if I look at my balance sheet date, my reporting date, something called as a subsequent measurement period. On the subsequent measurement, let us say if the market value per share goes to, let's say, $15. Should I show my financial asset at its initial cost of $1,000, or should I show the financial asset at its fair value or market value, which is 15 into 100, that is $1,500. Now this is a key attribute as far as the entire accounting standard is concerned. My financial instruments accounting standard talks about, should I show my assets, financial assets, at cost or at fair value? Is it okay? Now, before we get into it in terms of should it be shown at a cost method or should it be shown under the fair value method, let's try to understand the implications of these, right? So, let us say that if I'm using a fair value method, right, I'm not getting into the other leg of the accounting, wherein I'm purely looking at the balance sheet part of it. Is it okay? So what I'm saying is, when I bought it on day one, my financial asset is shown at $1,000. Under fair value method, let us say, year one end, I would like to show it at $1,500, right? Let us say that in the year two, my per share has gone to 20, which means my investment is going to 2,000, right? But then let us say at the year end 3, the dollar or the share value has declined to, let's say, 12, which means that now my investment is going to $1,200 at the end of the year 3. Now what we are looking at is using a fair value. So we are saying that this is at fair value. This is 1,000. It changed to 1,500. It again changed to 2,000, and then it decline. Further change of course to 1200. So you see a lot of volatility in your balance sheet. The numbers are changing time and again. And sometimes it happens without any fault of yours. You bought the shares in company Y, the other company. If the value of those shares are changing because of market factors, because of the fact that the company has done significantly great, or let's say they have probably not done really well, wherein the decline has happened, what exactly is your fault in that? And that is the big challenge with the fair value. That is a big challenge with the use of fair value. And that is where we say we need to be cautious. Or rather, the management is usually concerned, should they use the fair value? They might not be willing to use the fair value because the balance sheet keeps on becoming volatile, more and more volatile. If your financial assets are being taken at fair value, there is always a risk of volatility. The shareholders may not appreciate that the financial statements are not moving in a particular direction. They might not be really confident about the company in the perspective or in the sense that if, for example, in 1 year the company's financial statements are very strong, in the second year they decline significantly, the third year they again change positively, and so on and so forth, they might not want to trust the balance sheet or the financial position just like that. Are we clear with that? At least temporarily, it is going to have a serious impact on the worthiness of the company. So we can say that fair value is something which is not really used by, not really recommended by the management, because they are concerned that sometimes the balance sheet may go up and many times the balance sheet may come down. And that is where they are quite scared of the use of the fair value. Is it okay? But then we are talking about it if it were a cost method. Then what is going to happen? It simply means under cost method, theoretically, no matter the changes in the market value, we continue to show it at its original cost. So the asset is appearing as $1,000 each year. Are we okay with that? Is it okay? So the point we're trying to make here is, and we haven't really gone to the other side, the P&L impact of that, the credit impact of the changes, right? But then this particular accounting standard is a little more rigid. It says that if you want to go for the cost model or the cost method, or if you do not want to go for the fair value method, there is a requirement, conditions for cost model, right? There are conditions attached to be able to use the cost method by an entity for its financial assets. That is something which is a key attribute, that if you want to use the cost model, you must meet some conditions. Otherwise, default category is fair value. You are not skipped. You are not allowed to use the cost model if conditions associated to that, conditions related to that are not duly met. So let's try to understand what these conditions are and even try to understand why are these conditions imposed. Are you fine with that? Yep. So what we're looking at is the conditions for the cost model. We are saying, I think we can remove this. There are primarily two conditions, although there are three conditions. We're going to talk about today only two conditions here. The condition one is that business model of the entity is to recover contractual cash flows arising on specific dates. going to talk about that as well in terms of what it means. And second is the contractual cash flows are the or resultant, let's say, the recovery of principal and interest thereof. Let's try to understand what are we trying to achieve here. Let's look at that carefully. We're saying that the business model of the entity is to recover contractual cash flows arising on specific dates, and the contractual cash flows, so we're using and not or, so both the conditions need to be met, and the contractual cash flows result in the recovery of principal and interest thereof. Right? The key is that the very objective of these conditions is that irrespective of the changes in the value of the financial asset. Put it like this, that I have made an investment, it has significantly grown in terms of its market value. Now my intentions could be, my objective could be to, let us say, sell that investment and realize a profit. Is it okay? Which actually means I'm not waiting for the specific dates on which my contractual cash flows would have arisen. Is it okay? I'm looking at realization or recovery of that investment at the earliest. The moment I see an opportunity, I realize it. Which means my model is not to recover contractual cash flows on significant or specific dates, and for that matter, not even the recovery of principal and interest. I'm acting more of an opportunist. Let the opportunity come. I will avail that opportunity. I'll take the gains as and when they arise. And that is where we look at the criticality of this cost model, that irrespective of the changes in the market value, I'm not looking at the changes therein. I will be happy. I will be absolutely comfortable receiving my contractual cash flows on specific dates through the recovery of principal and interest. Is it okay? So if I say that, we are looking at a condition. We'll take some examples in some time about that. Right? Thank you.